In today's video, we're going to talk about how to think about investing in 2026. I read through your comments, and I keep seeing the same concerns again and again. People are asking, will the stock market keep rising in 2026? Is gold and silver already too expensive? Did we miss the opportunity? These are fair questions. And today, I want to walk you through how I'm personally thinking about 2026, and more importantly, why? Let's start with a simple reality that many people overlook. Right now, the Federal Reserve is moving toward making money cheaper, not more expensive. And when money becomes cheaper, asset prices usually respond. We're talking about stocks, real estate, gold, silver, real assets in general. This isn't a prediction. This is how the system is built to work. What is liquidity? Before we go further, we need to talk about one word that explains almost everything in financial markets: liquidity. In simple terms, liquidity means how much money exists in the system and how easy it is to access. When liquidity is tight, borrowing costs rise. Lending slows down, asset prices struggle, but when liquidity is abundant, borrowing becomes cheaper, money moves more freely, asset prices tend to rise. Simple analogy: think of liquidity like air in a balloon. When more air is added, everything expands. When air is released, everything contracts. Right now, more air is being added back into the system. Why the economy can feel bad but markets go up? This is where many people get confused. They look around and say, prices are high. People feel stressed. The economy doesn't feel strong, and they're not wrong. But financial markets don't move based on feelings. They move based on access to money. When liquidity increases, money doesn't sit still. It looks for a place to go. That money flows into stocks, ETFs, gold, silver, and anything viewed as a store of value. That's why markets can rise even when everyday life feels difficult. The Federal Reserve controls short-term interest rates. When rates rise, borrowing becomes expensive, risk-taking slows, cash becomes attractive. When rates fall, borrowing becomes cheaper, risk-taking increases, cash loses its appeal, lower rates change behavior. Across the entire system, companies refinance debt. Investors seek higher returns. Asset valuations rise because future earnings are discounted at lower rates. That's why rate-cutting cycles matter so much. Why 2026 is different here. That's the key point. We are no longer in a tightening phase. We are moving into an easing phase, and easing cycles historically higher asset prices, money creation. Let's talk about money creation. The Federal Reserve has restarted balance sheet expansion. They may use technical language, but the effect is simple. More money is being injected into the financial system. Markets don't care what it's called. They care about what it does. And what it does is increase liquidity. More liquidity usually leads to higher asset prices. Why this won't stop quickly? Some people believe this will be short-lived, but here's the problem with that thinking. The system today depends on liquidity. Government deficits are large. Banks require reserves. Markets rely on stable funding. Once liquidity support begins, shutting it off too fast risks breaking something else. That's why these cycles usually last longer than expected. The dollar connection: when interest rates fall and money supply grows, the dollar often weakens. Why? Lower rates mean holding dollars pays less. More dollars mean each one buys a little less. A weaker dollar tends to support stocks, gold, silver, commodities. For precious metals, prices rise not because the metal changes, but because the currency weakens. This is why gold and silver often perform well during easing cycles. This isn't ideology. It's math. The Fed history shows us something important. When markets face severe stress, the Federal Reserve steps in. We saw it in 2008-2020 banking crisis. This is often called the Fed put. It doesn't mean markets can't fall. It means major declines are usually met with policy support. Why? Because market crashes don't stay isolated. They spread into jobs, credit, housing, and confidence. At that point, intervention becomes the cheaper option. Why the system is so sensitive now? Debt levels are higher than ever. Markets are more interconnected than ever. That means stress spreads faster, and responses must be faster and larger. Looking ahead to 2026, there's another important factor. In 2026, there will be new leadership at the Federal Reserve. New leadership often brings a shift in priorities. Historically, that shift leans toward easier policy, not tighter, especially heading into political cycles where economic stability matters. Putting it all together, so let's connect the dots. Falling rates, rising liquidity. A weaker dollar and a central bank ready to intervene. This environment tends to support asset prices. That doesn't mean markets move straight up. There will be pullbacks. There will be volatility. But in liquidity-rich environments, dips are often bought because of these tailwinds. My approach for 2026 is simple. I plan to stay invested. I'm not going to sit in cash and lose purchasing power. And I'm not waiting on the sidelines hoping for a crash. In this type of environment, pullbacks are opportunities, not warnings. That doesn't remove risk, but it changes how risk is managed, and that's how I'm thinking about investing in 2026.